Please welcome the panel on Global Real Estate, moderated by Editorial Director of Bloomberg New Economy, Erik Schatzker.
Good afternoon, everyone. It's good to see you. Welcome to the Milken Institute Global Conference 2024 panel on global real estate. I'm Erik Schatzker. I'm going to quickly introduce my guests. To my left is Kathleen McCarthy of Blackstone, the behemoth in real estate with almost $350 billion in assets. Rabil, the CEO of Kayne, sitting to her left. David Steinbach of Hines, a company you may not know that well, global real estate manager with $100 billion in assets. And he's going to kill me for saying this, but on the far left is one of the elder statesmen of real estate.
Very
off the wrong foot. Who would that be?
Collectively, we've got about $600 billion in real estate assets on stage. Well, at least equity invested in real estate, of course, levered up. There's a whole lot more in real estate here. Global real estate makes this a bit of a tough assignment. Because as the saying goes, all real estate is local. So this panel, in addition to touching on overarching factors that affect all properties everywhere, will try to take you on a bit of a global tour of local markets, of asset classes, and funding sources. And I hope you will all leave enriched by the perspectives of our panelists. I would love to see some questions from the audience. Everybody, I have an iPad here. I'm going to try and weave them into the conversation so that they're contextual. Please don't submit the questions toward the end, waiting for a 10-minute Q&A period. There won't be one. So, without further ado, shall we begin? Real estate has been a painful place, as you probably know. The industry is dealing with a vexing mix of everything from interest rates to post-pandemic vacancies to geopolitics. There's been a lot of extend and pretend, keeping transaction activity down, not to mention plenty of uncertainty over the trajectory of Fed policy. So it's hard to know whether all the bad news has been priced in or not. The question I'd like to begin with to our panel is, have we hit bottom? At the very least in, say, U.S. commercial real estate, retail, or will this be a bumpy ride further down with lots of balance sheet restructuring ahead and a hard landing to come? Kathleen, why don't you start us off?
Thanks, Erik. From our perspective, we are bottoming, I would say. It's hard to ever know if you've actually hit the bottom until you're past it. But what we look at is that it feels to us that there's bad news coming, but it's mostly kind of the aftermath of the shipwreck that already happened. And when you see some of the building blocks of recovery coming into place, it feels like we're probably at the bottom. Now, we might not be heading straight up, to your question, but again, to us, it feels like when you have cost of capital coming down, which despite the fact that interest rates are still high, thanks to spreads coming back in, cost of capital is coming down. You've also seen in this cycle a very quick reaction function in terms of new supply. So new supply down sharply, even in strong sectors like logistics or rental housing. I think rental housing, this year we see starts 45% down versus the peak a couple of years ago. And so to us, that kind of leads you to brighter days ahead. But I think there's still going to be a lot of opportunity as, to your point, you have to work through over-levered capital structures, business plans that haven't worked. And that's where you're going to see the transaction activity coming as this kind of volatility settles out.
Who wants to go next?
I agree with the bottoming dynamic. Personally, I think that the Fed is in a situation, is between a rock and a hard place, and that the Fed will be easing. I've been in the hard landing camp for a long time. I still think we're going to have a hard landing, but I think the opportunity set is now, because I think the bad news, as Kathleen said, the bad news is in. And the reason that I think the Fed has to ease is because bank balance sheets are in a very precarious position. And when people talk about inflation, it's usually focused on price versus asset. but you've had massive asset deflation due to the fact that you had quickly rising interest rates, and that has put bank balance sheets in a very tough spot. And I think Jerome Powell, and I know Barry will have some very nice things to say about Jerome as the session continues, but I think that he understands that the greater risk between price inflation and asset deflation is asset deflation. So what does that mean? That means right now we're in the bottoming phase. We've had a lot of bad news, and I think we're looking at a more constructive interest rate environment going forward. And you're also looking at forced selling in many places because of structural leverage, which means, a very big opportunity. And I would say that much like the pandemic created winners and losers, I mean, you mentioned, Erik, real estate, there's been a lot of pain, and that's true, but there have been winners and losers. And we've focused on demographics as destiny for a long period of time, and the focus is really on inelastic demand. So when you're in sectors that have that inelastic demand, you don't get hit the same way that you do when you're in what I'll just say sort of a more macroeconomic driven sector. Obviously, the poster child for that is office space.
Al, could I just ask you to elaborate very briefly on what a hard landing looks like?
What a hard landing looks like? Well, we've had 8 inverted yield curves. This is the 9th since 1962. In 7 of those 8 times, an inverted yield curve has led to a recession. The only exception was 1967. So this is the second longest inverted yield curve that we've ever had in the last 50 plus years. So, what does it look like? I mean, I think we're looking at, I think there are a lot of deflationary dynamics in the economy. And do I think we're headed to stagflation? No. I think we've got a strong economy, but I think you're going to see easing wage growth, which, by the way, I think is another reason that now is the time to buy. And I would classify now as sort of today for the next 24 months, plus or minus, because the confluence of events, demand drivers, or demand tailwinds, if you're in the right sectors, supply tailwinds because you have massively reduced supply, combined with a buying opportunity, that's sort of the trifecta. And that confluence of events is not going to stick around for the next 7 years for everybody to feel comfortable.
David.
I think there's both a strategic lens to look at the market today and a tactical one. I think on the tactical side, I think that I fully agree that things are enough is coming together to feel that we are getting a sense of dollar cost averaging into the market is a very good play. And I think both credit and equity are both important plays right now. I think credit is a great play. I think my only concern on that is duration, right? I mean, you're going to get the money back after equity has recovered, and so I think you need to play both in the right balance. And right now, it's a bit more credit and easing into equity. So certainly, I think that is comforting. And I think this year there's going to be some transactions, particularly in office in large cities. I think that will help give the market a lot more confidence once that occurs. I mean, the minute a trophy building in New York trades, the whole system will calibrate around that pricing and think about risk reward from that data point. So we need to see more of that, and I think that'll happen this year. I think the deeper thing.
Well, some have traded at debt value.
Well, yeah. Well, true trophy assets. I mean, just what I'm seeing right now is there's a bid-ask spread of the best buildings, and they're not trading right now. They're not trading, and those owners have a good capital stack. Sure, they would like to recycle capital, but they're going to be patient and they're going to wait. And I think we're going to be surprised at the pricing once that emerges in terms of how keen the cap rates in those cases are. And that's very different than all the other stuff. But then on the strategic side, I think that's also a very interesting lens to look at right now. I think that we are at a moment of regime change in terms of interest rate, monetary policy, and thinking about how that future lens looks is going to be different. And I think the last 40 years has been downhill skiing in terms of declining interest rates, declining cap rates. And now we're in cross-country skiing. And it might be cross-country for the rest of my career. And I think that these two sports are different, right? They require a different way to play the game. And I think that smart investors right now are going to be thinking, how do I play this game differently in this new environment? And I think that it's a winnable game. It's just a different way to play it. And so for us, that is all about execution. That's a shift from beta to alpha. That's all about the hard work of creating cash flow, creating value. And I think investors in the real estate space, in a world of probably a bit higher than longer, real assets are something you want to own. And you want to own a lot of them. And I think we're going to see a real wave of capital come into the space from places like private wealth, which certainly hearing a lot about that here at this Milken. So,
Barry.
The elder statesman.
I've never been an elder statesman. I'm usually, so real estate was the collateral damage of Powell's rate move. We weren't his target. He was trying to bring inflation down. We weren't really causing inflation. I guess the rent component of CPI we had something to do with, but it wasn't like we created the pandemic and made people run to pay more for rent. And my criticism of Powell I think are proven to be 100% accurate, right? We had inflation because we had too much money, multiple stimulus packages, chasing too few goods, which was going to be a temporary phenomenon, and now the supply chain is fixed, and the global stimulus package is supposedly in the U.S. spent right now, and you're seeing weakness in the lower end of the economy. We see it in budget hotels, lower-end properties, Starbucks, McDonald's. Some of the credit card delinquency debt doesn't look good. So what he created was a balance sheet crisis, not an asset crisis. Real estate really wasn't overbuilt. The pandemic made office feel like it's overstocked. There's too much office and too much obsolete office. People have gotten pretty choosy about what they take. But this is really a balance sheet crisis. And I agree with Al. I mean, the Fed is very aware that he has a teetering regional banking system that loaded up on $700 billion of real estate loans, basically in a low interest rate environment, and the small borrowers are going to have a hard time refinancing. And the other side of their books are securities that they were told they'd never have to mark to market and are way below market today. And if you mark to market those books, they're insolvent before you get to the real estate. And it's inconceivable that the loan book isn't down 10%, and these banks are levered 9 to 1, 8 to 1, so their equity is gone. They exist by the grace of God. And as long as that situation is there, and the government is very aware of it now, and I'm sure Kathleen has gotten calls, we've gotten calls. How quickly can you take over banks' assets? They're trying to arrange recaps before they fail. So there's a huge distress cycle in front of us, and the length and depth of that will depend on what Powell does from here. I think it's fairly inconceivable that he raises rates. I don't think he doesn't want to, and if he does, it's stagflation. I don't agree that it's not stagflation. Inflation is coming from services. It's coming from healthcare. Healthcare and education and government jobs are 50 million jobs out of 160. They've been adding jobs every month. Last week in the employment report, 175,000 jobs, 100,000 were in healthcare. They are not interest rate sensitive jobs. He can't stop it. In 07, 08, we added 354,000 jobs in those industries in the worst financial crisis pretty much any of us have ever seen. So he's using a tool on the other portions of the economy that if he overdoes it, he will create the hard landing. That means he has to get hotels to stop having conferences, businesses have to stop traveling, we have to stop shopping, there have to be layoffs in retail. He can't get layoffs in construction workers because we're all building the Amman next door here. I mean, there's a lot of data centers being built, chip plants, roads, bridges, and tunnels, and he's getting no layoffs in the construction industry. We lost 1 million jobs in 07, 08 crisis. He's gotten 0. And hospitality is now full. We've actually replaced all the workers we didn't have in the pandemic, and it's actually thankful for the migrants actually that have helped ease some of the inflation pressure, because you couldn't get anyone to work at McDonald's, and you couldn't get anyone to clean a bed in a hotel, and now they've come back. Many of them are, I don't know if they're undocumented, but they're definitely lower workers from the lower side that have taken jobs that traditional Americans have not wanted, don't want anymore. So I think we're definitely bottoming. But like any cycle, you're at the point of the cycle where the bid-ask spread, at least in the United States, is very wide. Kathleen, us, and plenty of you have plenty of ammo, and nobody wants to sell because they think it'll be brighter when rates come down, and I believe the rates will come down. And so if you can stay alive and survive to 25, you hold your assets and you don't sell. And there's probably 100 basis point spread between asks and bids. And this is the truth. This is what happens in every cycle like this. And the banks, which normally would get rid of stuff, I mean, they're working with us, and I'm sure everyone else on the stage, and says, well, we don't really want that building back. So he'll give you a little pay down, and you work it for us, and then we'll take it from you in 3 years if the world's still bad. So you haven't seen that much. You're seeing some short sales, banks coming up and saying, just sell it for me. I don't want it ever to hit my book. And it's spreading. Multifamily now is in the crosshairs. If properties were bought for a different rate environment. And it's not, people say this silly comment that, well, real estate was fine with 5% interest rates, and it was. But they were 5% for a long time, or 6% or 7%. I started, they were 8 or 9%. It was the pace of the increase, straight up. And it was the fact that he told everyone in December of 21, real estate lower longer. And he enforced what he said by continuing to buy corporate bonds through May of 22, and then he reversed bigly and increased rates 500 basis points super fast. And that balance sheet crisis had a lot of impact, not on what he wanted, which is the job market. Miami has a 1.5% unemployment rate. It's not working. In the meantime, he's killing asset prices, and not just real estate and fixed income, infrastructure. If you bought, roads, you bought with you may have long-term debt, but some people had floating debt or have caps. But he's definitely changed the playing field, and it is a giant asset class. It will recover, but there's no reason the world should grow super fast right now.
But
So
I think that's starting to reverse
Yeah.
now. I think if you look at the Fed and the conference call, or the Fed minutes, that was a pretty big easing, actually. I mean, he didn't lower rates, but what he did was probably the equivalent of a 40 basis point decrease.
You're talking about lowering selling off the balance sheets more slowly.
On the balance sheet side. So, and I would say I'm in.
And rates are coming down in Europe, so
I'm in the 3 cuts, and you heard it here first. June, first cut. So June. I'm going June. I mean, September
Break out the champagne.
looks incredibly. September looks incredibly political, which maybe
are you buying the champagne?
Maybe he's not worried about that. But
It is.
I'm going June.
Can we go back to something Barry said just about kind of the transaction environment, right? And how where we are at really in terms of bid-ask spreads, and also trying to globalize the conversation if helpful. So, I will say in our business, we have $600 billion of real estate. Americas, Europe, and Asia is where we are active. Last year, really for the first time ever, more than 50% of our investment activity was in Europe. And that was because I think the pain from sharply higher rates was more pronounced there. And it was because that differential, while the speed was kind of similar, the differential was bigger, 5 times greater cost versus 2.5-ish or 2.2 here. And so, in sectors we liked, we were transacting with over-levered companies who were doing all the things you expect to do, sell good assets to de-levered, public companies that weren't happy with where they're trading, private funds who were under pressure to create liquidity. And that, of course, though, has been slower to play out here in the U.S., for all the reasons we've talked about in terms of people able to hang on, capital structures not necessarily maturing. And I'd say, even places where there's some over-leverage, you have had cash flow growth in places like warehouses and rental housing and things like that because you're marking leases to market even as you're getting slower market rent growth. This year, though, I would say, at least speaking for our business, has felt quite different. I mean, we in the past couple of months have had 4 major transactions. One, Barry referenced the idea of buying a portfolio of loans that were really the collateral damage, literally, of a failed bank. We partnered with the FDIC, buying 20% stake on our side in a portfolio of $17 billion of commercial loans. Pretty much all performing real estate, but you're able to set up at a discount because those are primarily fixed rate loans set in a different environment, and to reflect the cost of capital today, you get a big discount.
That's the signature bank deal Kathleen's talking about.
And then we've had 2 major take privates, both in the residential housing space, a $10 billion transaction. We're under contract to buy Air Communities, Tricon, Canadian listed. We have our Canadian here. Actually, dual listed U.S. Canada rental housing company, and then also partnering with public companies. Remember, public companies need the capital markets open in order to access the money they need to grow. And even in great sectors, we had a public company, Digital Realty, have data centers ready to go in Europe and the US and unable to access the capital. We've been able to commit to a joint venture with them. And so this is just, again, I think signs that there's a bid-ask spread, but it's like you're starting to get to the point of either kind of frustration or capitulation, and it's just playing out differently at different speeds in different parts of the world.
And since we're global real estate, let's back up. I mean, I think we've done what Blackstone's done. The last $3 billion of equity has been international. And things are moving quite quickly through the garbage can in Europe. Like, the banks want to sell this stuff. And as you pointed out, they're actually in their financing markets are not as difficult as they are here.
It's very different than 08.
Yeah, it's
right?
very different than 08. The banks are open. And Japan, there's no distress at all. It's a free-for-all. It's an amazingly there's positive leverage. They've let the currency go to the toilet. It's incredibly cheap. And Japan is going to have a competitive advantage because their companies will be very, very competitive on a global basis with the currency where it is. And in the inverse, or converse of that is the US. If he does keep rates here and Europe does lower, the euro will continue to be under pressure. American exports will be under pressure, which should slow the US economy. And we'll make all the imports we do
I do feel like, though,
more expensive.
Given the 500 basis point increase we've had the last 2 years, it feels to me like we're more fine-tuned. I mean, honestly, in underwriting, 25 basis points is not going to drastically change your worldview or what you're doing. It feels more like we're in the stages of fine-tuning around the edges versus, again, 500 basis points is quite dramatic.
Yeah, but directionally, it matters. It took us 220 years to have our first $11 trillion of debt. It's taken us the last 3 years.
Well, these are deeper.
Next 3 years is another $11 trillion
it's not
of
trivial.
debt.
Right.
And it's $1.3 trillion of debt service coverage per annum. There are a lot of reasons to lower rates, all of which Powell, I think, is very aware of. And I would just push back. It's not really push back, but I would say, listen, if you're Blackstone or Starwood, you're talking about large strategic acquisitions, and there is a bid-ask spread there. I think part of the benefit of being smaller, I said, our platform is one of Blackstone's funds, but we've been buying at 7% cap rates because the structural leverage doesn't work for a lot of.
What are you buying at 7 caps, Hal?
Medical office, seniors housing, student
Medical
housing.
office you can buy at 7.
Yeah, so. But I'm just saying.
But I'm talking about
you're not dealing with large. It's like if you lend $1 billion, you're a partner.
No,
right?
in industrial at the granular level and apartments at the granular level, there's a bid-ask spread, and it's pretty material. I mean, it's somewhere between 5 and 6, kind of. And industrial, you occasionally see people wandering. The really good news is we all know there's a lot of dry powder. There's a lot of money that wants to get put to work. And it will favor certain asset classes over others. Particularly, it won't favor office. But like I think you said, David, I mean, the high net worths are stepping into the market. They're buying stuff they could never, and they're looking at it. You say, when I was younger, last week, somebody said, I was speaking to one of our Chinese investors, and I said, why did you buy that office building at a 4 yield in Manhattan? They said, we have enough of your treasuries. And
further.
Well, let me just finish, and then you'll go. And then they said, so today, if you're a high net worth and you can buy the Montage, which Tillman Fertitta did down in Laguna Niguel at a 6.3 or 6.4 cap, he's got enough treasuries. I'm going to own this really amazing asset. I'll probably keep it really lightly levered, and in 20 years it'll be worth more. And he's absolutely right. It'll be worth more, and he'll get inflation in the rents. In the rates, and so. Individuals, high net worths particularly, which are becoming a material part of the real estate market, they're wandering in and say, I'll buy that beautiful office building and I'll buy that great apartment, and they'll keep it relatively unlevered, and if rates come down, they'll lever it later. Right. So we have this reverse LBO impact, and they're important players in the market. The institutions always get scared at times like this. These are always the best vintage funds we ever have when there's a crisis. And the attachment points where we're buying stuff will be very attractive on replacement cost, and the fact that supply has gone down. But you're shopping it, and we shop a global world. We look for any asset class in any market and up and down the capital stack and try to be dexterous.
The audience would like to know, what precipitates this forced selling we're talking about? What forces the deleveraging? What
if rates stay here, it's happening.
I mean, yeah, I'd say a couple things. One is you can have a maturity event, right? Many of these capital structures were put in place not with 20-year or 30-year durations like a home mortgage. And so you can hit a maturity event, and even if you have an asset that's fully leased, you can't replace that debt at the same level, or certainly not at the same cost. And so you need to basically bring down the leverage to what's available or what your cash flow will cover. I think the other thing that precipitates it in advance of an actual maturity is the need for real capital to go into the asset. So if you have a 60% leased office building, and you have an opportunity to lease up the rest of that space, that's going to cost you a lot in terms of tenant improvement allowance and leasing commissions. By the way, you could also have a situation where you have to pay a big tax bill. And if you're the equity owner and you don't think you're going to get a return on that capital, you're never going to recover it, you're going to call your lender and say, hey, we have to find a way to make this work, or you're going to have to take control of it. So I think that, and that, again, is starting to happen. So, someone referenced the trades of the weaker assets.
Yeah, there's one more category too, which I would say there's a lot of investors that do need liquidity, and they're going to look to some of their best assets to find it. And in moments like these, they're able to find it, and sure, they're going to take a discount, but they need liquidity back into their overall system. The other point I also want to make too on the high net worth, I just think it's so important for everybody to understand is just the magnitude of what opportunity this is. This is a multi-trillion-dollar space. And most high net worth investors on average are 4% allocated to real estate. Meanwhile, most institutions are 10 to 12% allocated to real estate. So only a few percentage points in a multi-trillion-dollar space is a lot of capital that I think is going to be coming into the system at a time that a lot of institutions are potentially going to be maybe a bit more on the sidelines. And I think that might be a blind spot that a lot of investors have today, not realizing that these other pools of money are being formed very quickly, and a lot of people are going after them, including most of us on the stage. So
back to your question, Eric, it comes down to liquidity. What really triggers it? I mean, what we were talking about earlier, the regional banks, 1.6 trillion of real estate debt coming due by year-end 2026. More than half of that's with regional banks. More than 20% of that's office. Not all of that's bad, but not all of that's good. I mean, you talked about the loan portfolio we've bought loan portfolios at discounts, and it's the best performing stuff. So banks are selling their best performing assets to create liquidity. Where are their worst performing assets? And the reality is
and that's
how much, and private equity is filling the gap, but they're not filling the gap for, they're not stepping in and filling a complete void for where the banking
We haven't seen them selling their best assets. I mean, we see them selling their crap first. And like they put out a portfolio of office buildings, 1.2 billion. This is in the marketplace right now, 1.2 billion face, and you think it might be worth 30 cents.
Well, they want to sell
and there's
office,
suburban, generic office buildings in Indianapolis and Cleveland. Like there's just, sorry if you're from Indianapolis or Cleveland, but those aren't hot spots.
We're seeing good stuff now because it's the same thing as the equity markets. Yeah. You may want to sell your crap, but there's not a bid for any of that. So it's like now you have to create liquidity, and so now you're selling some.
And I think those investors are going to be patient, and there is a bid-ask spread there, but there will be a coming together eventually. And these are quiet conversations too. They're not necessarily going to a broker to have those transactions.
But if a bank's selling 60% LTV loans with 9.5% debt yields at 10% discounts to NAV, how many new loans are they looking to make? None. They're not. So when you have a maturity, the cash in refinance, new term, it's like, okay.
Fundamentally, like the European markets are in large part much better than our markets. There's not an office market in Europe that has a 10% vacancy rate. Not one. You can't find one. Here, there isn't one below 18. There's sub-markets that might be below 18. Park Avenue might be 6.5%, but there's no city that's running less than a 15, 18% vacancy rate. With sublet space, I think Austin, Texas will get to 30% vacancies. I mean, 30%, that's like even high in my older years having done this. And Europe, I mean, Munich, 2% vacancy rate in Class A office with a 15% rent growth last year. Berlin, 5-6% growth. In Berlin, 4 or 5% vacancy rate. New buildings, the vacancy rates are overstated. If you actually look at the numbers, London is having a field day right now in office. It is leasing like at higher levels and faster pace than pre-pandemic. So this return to work thing that the federal government and some of the state governments and to some extent the tech companies have adopted is a US phenomenon. It is really not what you see around the world. Seoul office, less than 4% vacancy rate, Tokyo 3%, and there's a lot of space they absorbed. So we come at this with the US lens and our US experience, and as Kathleen pointed out, you're setting the stage for a fairly significant recovery in housing in the United States, and also in industrial, I think, given the crash in starts. So, and that's replicating itself. Blackstone has an enormous platform in industrial in Europe. We have done a very large logistics deal in Australia. It's a 1% vacancy rate in logistics in Melbourne and Sydney. So it's the benefit of having the ability to go across the globe and pick the right asset class in the right location and use the headlines that you hear about at things like this to find the deals that nobody's looking for because everyone's running away. And I think all of us have been pretty good at that. So, and hopefully we'll continue to be good at it.
Member of the audience astutely points out that Cleveland gets no respect.
We have a hotel or two you can have from us in Cleveland for. If you give us $1 over the debt, we're good.
People here and elsewhere have been hearing for some time that
we don't.
Data centers are hot. That energy storage is a hot market for real estate investors. One question, how long a tail is there to that trade, as it were, and then secondly, and I think of more interest to people perhaps, where else? What else looks like there's a growth opportunity there, or at the very, very least, a great opportunity to generate alpha?
Well, I'll start on data centers. I think we're really just at the very beginning, actually.
Super early.
Super early. And I'd say this is an opportunity in terms of both the activation of all of this compute power and then all of the needs for power and power innovation and grid development and redevelopment. I mean, there are going to be so many ways to express this opportunity, but as it relates to real estate, data centers are the physical assets that are benefiting from this explosion in information and digitization. We took private a company in 2021 called QTS. It was the 5th largest data center business at the time. It's now, I think, the largest in the US and the fastest growing globally. And what you realize in this business is that, one, it is a voracious user of capital. And that actually is quite hard to be and do in the public markets, as I said before. So it kind of more naturally, I think, lends itself to private capital owners who can bring that. And then, the other thing, and we could get into a broader conversation about every real estate sector being this, but this is a customer partnership business. You have to have the know-how, the knowledge, the team, and the relationships to be that partner of choice, because the real estate is so important to the largest technology businesses in the world, to the federal government, and really meet them where they're at in terms of generating all of the capacity that they need to continue growing and meeting their opportunities. And I think, to the point, this is a global phenomenon. I think also, some of the rules and regulations and things that will come in that will require, home domiciling data. We see this, for example, in India, where we're building a company really focused on Indian data centers, because it's the largest population in the world, fastest growing as well. Most digital payments anywhere, and those are going to have to likely happen all kind of onshore in India. And so this feels like just the very beginning. And there are, again, the amount of capital required is meaningful, and that's to some degree is creating kind of a barrier to entry that doesn't exist in like warehouses, for example.
Yeah, so fully agree on the opportunity set and using the Gartner, hype cycle. I mean, there certainly will be a hype cycle. It feels like we're still really early. What I think is also interesting to think about as investors is what are the unknown pinch points that are going to come, right? So energy is clearly one of those. And you know, you're already seeing it today where places like Ireland, you can't just build a data center and plug it in. And I think this era of building stuff and plugging it in is going to end. You know, whenever you think about the U.S. the last 25 years has doubled its size of the economy, and our energy with the same amount of energy usage. And so there isn't even a muscle memory of how to scale our energy grid and energy distribution systems. And so it feels like the world is coming unprepared for this AI revolution that's coming, and the data centers that will need to support all that. And I think when I think about the built environment and I think about how this energy problem is going to be solved, it feels like it's going to be much more of a localized solution, which is a distributed solution, which I do think the built environment is going to have a general interesting answer to that is yet to be written. But certainly as I think about the impact of AI and data centers, energy, and what it's going to do to the broader economy and the broader elements of our business, I think we also need to keep our eye on. Because as one area gets squeezed, and another's going to feel it as well. So that's how I would put the overall.
I'll pick
on
up
the
on
AI front. I would just, sorry, I'd just say the two key themes to this whole conference: AI, data, and demographics. And so, to your question, Erik, where are other opportunities? I mean, we've been investing in healthcare infrastructure for the last 15 years and educational infrastructure / real estate. So if you look at 65 and older Americans, 40 million to 81 million, 2010 to 2040. 80 and over Americans, 13 million today, by 2040, 28 million. I mean, massive increase in the population age and those who need healthcare needs, because 3 times more doctor visits 65 and older versus the 64 and under age group. So just a massive increase in demand. What's that being met with right now? A massive decrease in supply. So you're at an inflection point where you have massively escalating demand, and because of interest rates and illiquidity, you have massive decreases in supply. You're not just going to flip a switch and say, oh, guess what? We don't have enough housing for seniors. We don't have enough medical office. We don't have enough XYZ. So the demographics as destiny dynamic and what exists today, because you don't need lower interest rates for what we're buying to work, because you're in double-digit rent growth markets.
We'll go back to data centers for a second.
Well, let me just finish, because you're
finished.
You're in 9 to 10% rent growth markets. So, Barry, being the elder statesman, he recognizes that this isn't a high interest rate environment. It's just the rate of increase, as you said earlier, Barry. 1962 to 2008, we didn't have a single year until 2008 where the average 10-year Treasury was below 4%.
It's not the level of rates. So going back to data centers, there's no question. I think Stanley Druckenmiller said it on TV today that we're probably short-term, it's a bit of a frenzy, but long-term, we're probably underestimating the need. And he was really reflecting on the prices of NVIDIA and some of the public stocks, super microcomputers. We're fairly active. I think we're the 4th largest in the world in data centers. We have 50 people doing this now in Europe and here. I think the 800-pound gorilla is not the demand. It's there. We'll figure out the energy grid, whether it's renewables. We're ingenious. We'll figure it out. It will be renewables in many markets. Europe doesn't have gas and doesn't have excess oil. The exits. This is an overgrown industrial building. It's a lot more expensive. It's got a great lease in place, 15-year lease. It has steps. But they're billion-dollar assets. And how will we exit these things is kind of the 800-pound gorilla question we ask. Where are we going to get out of these? And will we take them public? Will we sell them individually? There'll be buyers because it's yielding credit, and it's the best credits in the world. I mean, you have Amazon, Google, and Meta on these credits, and they're corporately guaranteed. So I think that will be interesting, because all of us it is an enormous use of capital. And people are raising dedicated data center funds. And then you have the crossover of infrastructure funds and real estate funds. An infrastructure fund will do a deal to a 13, and we want to do deals to 20s. So it's kind of, there's a lot of money that's coming to this sector, and there'll be mistakes. And the other thing that sort of makes me scratch what's left of my head is the tenant base. There are 6 or 7 giant tenants, and 2 of them are wildly aggressive. and they could turn it off, and people might get hung. Like they could decide to take a break, and people are positioning and trying to get power to feed these giants. So I do wonder if they've told every single person on this stage, if you get power, we'll go to you. And then if the first one who shows up, and they're good with that one, and the three of us are left with, so it'll be interesting. It's a bit of an arms race. And the demand is virtually infinite. The rents are rising both here and in Europe. And it's so far, it is definitely the bright spot in the real estate world. And I don't think I've ever seen anything like it. Not with 7 tenants, right? Driving everything.
We won't digress this way, but we are going to have to get serious about the energy conversation, because renewables will provide more energy, but the world's going to need 1.5 to 2 times more energy over the next 25 years. And it's not, so you could massively escalate the amount of renewables that we have, and fossil fuels are going to be here for a long period of time and have to be part of the answer.
Further, we
have to be part of the answer.
Further, we are electrifying everything. We're not, a lot of industries are getting starved of capital that were traditional bases. And further, the grid is how energy is distributed. You only put so many electrons through a wire, and you just can't keep putting up wires because of NIMBYism, which has only gotten harder and more difficult. So I agree with you. I think it's there's a deeper topic there that I think there's going to be economic opportunity in it. There's going to be opportunity in it.
There's a math dynamic.
Sure. Yeah.
And we're blessed that we have a country with massive natural resources.
Right.
So reality is going to crash into theory
we will figure
very
it out
soon.
Right, we will figure it out. It's just that there's an economic opportunity embedded in that, though, too.
The audience is curious about where to invest in real estate. We've already heard from this panel about what's going on, the opportunity that's in Europe, for example. Barry, you spoke about Japan. Perhaps somebody else on the panel would like to weigh in about Japan, because what's going on there is so interesting. But specifically where? People are asking, what about Dubai? What about Toronto? What about Singapore? What about London? So maybe we could spend a bit of time talking about specific locations that you like, perhaps some specific locations that you think don't merit your interest. Who wants to start?
Well, I would just say, obviously you have some others touting other places in the globe. The dollar's the reserve currency. That's not changing anytime soon. We have rule of law. It's a single country. So far, we're not socialist. So I would say that the U.S. is the place that you want to be longer term. And of course, opportunity sets ebb and flow. So not eschewing the fact that there are opportunities in other parts of the world. But I think when you're looking, as an investor, and you want both upside optionality and downside risk protection, you look at the U.S. first, you look at it second, and you look at it third. That's just my perspective. Now,
we wouldn't agree. We won't agree with that.
Yeah.
We won't agree. We don't agree. I mean, rates will stay higher longer here than in Europe, and you'll have positive arbitrage to both yields and the cost of debt in Japan and Europe. Europe has less supply. It's a dormant economy, so it's like, but there's huge holes in what they have, and you can find them. I mean, I think obviously the office markets are not even close to the health of the U.S. office markets. They're multiple times better. And rents are rising across the world, and they're not rising anywhere in the United States, and they're falling, and will fall significantly in the office markets going forward. As assets change hands, buildings in San Francisco that were bought for $800 that have debt of $400 a foot and trade at $250 a foot, and I own that building at $250 a foot, I'm going to charge $30 rents, not $80 rents. And these markets will ratchet down. As the assets in these markets trade hands to new bases, you will destabilize these markets. It'll be worse in the office markets. It'll be better in other asset classes because you don't have that kind of situation. But that is radically different in the U.S. I love our rule of law. It's hard to tell we have a rule of law these days. And but West, I'm not talking about going to Biafra or the Congo. I'm talking about, we've been very active in Italy, been very active in Great Britain, in Finland, Sweden, Spain, and Japan and Australia, and that's about it. Singapore is a great market, just to talk on one market that's been benefiting from China's situation. More than 100 families have moved their net worth there. Every office building is completely full. Every single building being built is full. We met with an insurance company there. We had to meet in a Starbucks. They did not have, this is one of the largest insurance companies in Singapore. They have no conference space in their offices. Everything has been taken up by offices. So if we could buy one, you'd be buying it at a 4 yield, or, and you'd ride higher rents. It's a totally different thing. And for opportunity funds, we haven't taken that kind of like trophy bets and ride rents, but they're definitely, and Hong Kong is sort of China now, so a lot of companies that want, or expats that would go to Hong Kong are going to Singapore. So Singapore's terrific. The West End of London is incredible. I mean, we took an incredibly expensive lease on our office space in central London, and it's probably 30% below market today. And we bought it like 2 years ago, 3 years ago. You cannot find space in Mayfair if you want to find space. And we built a building in Miami, and we started, the first lease was $54 a foot. The last lease is $115 in the pandemic, 100% full. You build the right thing, as you talked about, you add value, you understand the markets, and you actually can make a lot of money in real estate. It's very hard to talk about real estate at this big level. We have to worry about capital flows and interest rates, but real estate is block by block. It's not on the computer.
So coming back to the question, I think I would echo U.S. conviction market, Western Europe. I'd note the U.K. for all of its self-inflicted wounds, and there have been many. That has been a very productive and successful market for us, in part because sentiment has been so negative that when you have those moments where value basically dislocates from kind of underlying fundamentals, that creates opportunity. So we continue to invest actively there. One market that hasn't been mentioned but is a high conviction economy for us as a firm, not just in real estate, is India. So we started investing in India after the global financial crisis, when a lot of global capital left. And we started in the office sector, buying office parks that we had the capacity to continue growing as tenants grew. And those tenants are some of the best tenants in the whole world. It's our most blue chip rent roster, because what you see happening is that around the world, businesses are going to India for highly trained technical talent, English-speaking talent. And the call center is not what it is. This is very sophisticated work, technology jobs, banking jobs, and we have been able to kind of ride that theme in and out of capital market dislocation in India, and then extend what we're doing into retail. It's one of the only places in the world, similar to office, where we really like the retail business, and that's because you see this growth in the middle class, fueling greater consumption. That works for e-commerce as well as brick and mortar commerce. I mentioned our data center business. And we think there's also a great opportunity we haven't tapped into yet, but for hospitality as well. I mean, this is the biggest population in the world, and it has a teeny tiny fraction of the number of rooms the United States has. And so I think this, again, is a theme. And some people have said, demographics is destiny, but I would say also, the conditions on the ground are pretty unparalleled in the world. When you see the rate of economic growth overall, I mentioned the population growth, the growth in the middle class, and the fact that there's been political stability, there's been interest rate stability overall, inflation stability, again, all a bit higher than here in the US, but a very interesting market. And the only caution I would say is that you have to be aligned with the best businesses and the best partners. I mean, you cannot go sort of dabble in India and expect it's going to work out and that you're going to be able to exit on the other side.
I also want to amplify the India point. We've been in India as well for a long time, and it's unbelievable what's happening there, just to amplify that. It really is. And just the Western companies that are coming, and it's just not at all what you think in terms of the setup and how Western companies are using India for higher skilled labor than ever, and build it and they will come. I mean, it is unbelievable what's going on. So,
do anybody in the panel want to dump on something other than commercial U.S.?
Pardon me?
Well, we talked about how unattractive U.S. commercial real estate is, and
I mean,
offices
look,
in particular,
we
right?
like the resi sector in the U.S., almost everything in it, and we think is attractive. Lodging, you can always find interesting things to do in the hotel markets globally. It's a growth industry. Europe's recovered further than the U.S. Rates are higher versus 2019 in Europe than they are here. They're like 113% of 2019, 130% of 2019 in Europe. Europe hotels, because there aren't a lot of them, And the Chinese haven't started to travel yet. And when they get back to London and some of the other European capitals, these rates will go even further through the roof. So lodging is interesting. It's just you're a little reluctant if you have a hard landing scenario in your pocketbook to buy hotels right now, is in the US in particular. Where actually I think what's happening here is fascinating. The transient demand is slowing, but the group demand is staying strong. Yeah. Businesses' profit margins are great, and people want to get out and do meetings. And if so, that's been amazing how it was, not only did it come back after COVID, it stayed strong. Right. And when you look at Hilton and read their reports in Marriott, the group booking is fascinating. And look how well attended this conference is. Yeah. You know, it's, and there's half a hotel here. So it's, who knew you could tear down a hotel and book a conference? It's a whole new thing.
That's where you get
a
high correlation between the macro economy and the underlying asset class. One of my sayings is find the demand and let it run you over. So, you know, in terms of multifamily, I would say there are really two markets. I mean, there's a Class A and a Class B. You know, you could parse it farther, but let's just say Class A and Class B. And of 2.5 million units built over the last 10 years, 2.1 million of those are Class A, 400,000 Class B. 90% of the Class B housing stock in the U.S. was built in the year 2000 or earlier. So you have a 25-year-old housing stock for 90% of the Class B multifamily units in this country, and estimates range from 4 to 8 million, pick a number, in terms of the undersupply over the next 10 years in Class B. So it is a massively undersupplied sector with a growing renter base, because you've got inflation outpacing wage gains in many markets, and even if that switches, you have a massive undersupply. So love the workforce housing, also known as Class B or attainable. I think very different than Class A, where there are pockets, obviously, of, you know, there are markets that are successful, like Phoenix as an, you know, as an easy example, massively oversupplied.
Yeah, the one thing I also like about multifamily, and by the way, living, I think, as a global concept, there is a lot of undersupply around the world in terms of what's needed. And so the U.S. is 3 million houses short, Canada's short, Australia. I mean, you just go down the list of countries around the world, there is a tremendous amount of opportunity in that. But the other dynamic, especially for rental apartments and BTR, is that the leases are annual, and so you mark to market much more quickly than office or industrial.
In some markets.
In some markets, right. But in general, it is the asset class that's going to get hit soonest, but it's also quickest out because it's able to get out of a down trough faster.
Well, and I think, you know, to build on that, you know, again, we're operating under the assumption that there will be easing of rates, but they will likely be higher than what we've experienced in more recent history. And so, to come back to a theme somebody brought up earlier, this just means you need to be able to propel the value creation. You need to be able to continue moving your cash flows up. And so you want a portfolio in sectors, and I think we've all said this in different ways, and geographies as well, that are the beneficiaries of tailwinds that are kind of propelled from outside of real estate. I mean, we'll always look back at the, you know, the specific fundamentals or attributes of an asset or a market, but it's like, what kind of tide are you jumping into? And then are your lease durations short enough to be able to catch that and then move the cash flows up? And I mean, that has been, you know, even predating the environment we're in or COVID, one of the challenges for office assets is that you have at best maybe a zero coupon bond in a lot of situations, and oftentimes it's not zero because you're investing so much capital. And that just doesn't work if you're not getting the benefits of multiple expansion.
Can we spend a few minutes before we run out of time talking about sources of capital for the real estate industry? You know, I wonder, I think others may wonder as well, where's the money going to come from? You know, the Koreans have taken it in the teeth, you know, on some U.S. commercial real estate investments. The Chinese capital that was prevalent for a good period of time in the 2010s is probably not coming back. You know, credit from regional banks isn't going to be there the way it was. Where is the money coming from? Is there, where do you see it coming from? Is it going to, are the Chinese money and Korean money going to be replaced by Middle Eastern money? Or, you know, we talked about high net worth. Can family offices fill the gap here?
Well, I think, I'd say a couple of things. One is there are certainly speed bumps happening for institutional capital globally, and, you know, some of that is just, you know, portfolio construction or challenges with, you know, what has happened on the more liquid side of their books, and that's making everyone feel a little capital constrained today. But when you look at kind of medium to long term, the growth in capital for these young and growing countries, whether it's Korea or some of the Middle Eastern countries or more of the Asian countries, or you look at places like Australia, which has forced savings at a higher and higher rate. I mean, this is an enormous amount of capital that is coming into the global real estate economy, and either intends that long term they'll be staying at the levels they're at, or I think growing and participating more. So I think that, I look at it as like there's temporary constraints, but there is going to continue to be a lot of appetite. I think also, and it's been said a few times, but really when you consider it, individual investors, and whether you're ultra high net worth or you're a middle income saver, they've really not had access to real estate in any kind of formalized way. I mean, you can always trade a public company, but that's the U.S. REITs are something like 8% of our entire market. It's not really accessing the whole market. It's highly volatile. And in a world that we used to have, where everybody was benefiting from the pension plan they were in, investing in real estate and private markets on their behalf, that capital was getting to our sector. And now the people are going to just want to access that more directly. And that's why you see vehicles being built to serve that client.
So in general, capital flows are definitely down. The recovery of the equity markets has helped the U.S. plans because they might have thought they were 13% in real estate because equities are down, equities are back up, and now they're 10% again. So there is interest around, and I think investors, like they do in every cycle, in every location in the world, they're being picky. They're being picky by asset class, by manager. They're scraping their books, trying to decipher the differences between managers. I said this at our LP conference, and it's worth saying. Different managers have different marks today. Like, we all may have different views of what is the exit recovery from an office building or even an industrial building or a multi that we own. So some guy might be exiting at 5 in his model, another guy at 4.5, another guy 5.5. The disparity of marks among managers is always the greatest at times like this. And people will be surprised. In the last downturn, I was on the board of Brown, and I was on the investment committee. And they asked me to look at their real estate managers. First, I'd never heard of almost any of them. So they had adverse selection. They picked a bunch of guys who charged them nothing to lose all their money. And then I looked at the marks, and even at that time, the marks, like the exit cap rates were 3s or something, and the market was a 5.5. And I said, get rid of everything you have. And they sold every single position they had. But there's, I think people are smarter. Our investors are much more sophisticated. They have better staffs. They've seen the good, the bad, and the ugly. And I think it's really important for younger people in the audience to treat your investors like really convince them it's their money. It's your money. Like, you are aligned, and you're honest, transparent, and you tell them what's going on. Because everybody knows everyone makes mistakes. It's a cliche that Babe Ruth struck out more times than he hit home runs, but hopefully you don't do that in investing. That often doesn't work. But if you've done something, you have an issue somewhere, and we just try to. The hardest part of success is to keep your intellectual humility, and I think we're all humbled by what happened with Powell. I think he probably was surprised inflation didn't turn out to be quite as transient as he thought. And so it's, but it's great learning, and today, it's great opportunities. So going forward is going to be pretty exciting, I think. Institutions know that.
I think you mentioned it earlier, David, 4% of ultra high net worth. I think democratizing access to alternative investments is something that's started, but we're in the very early innings, and that's going to continue. And
it's been a tough lesson, though, for some of the retail investors.
Yep.
Blackstone has a retail vehicle. Starwood has retail vehicle. They are, at the very least, have generated some differences of opinion, perhaps some controversy, including this morning. Is it? I guess is it really? Is it for everybody? When the retail investor wants liquidity, the liquidity is not there.
Well, I think you're hitting on the most important point, that these are vehicles, these are real estate investment vehicles. They have liquidity up to a limit, and I think I can speak only for our vehicle, our non-traded REIT, B-REIT. it's working as intended, which is that we provide liquidity up to 2% a month, 5% a quarter. We've been able to do that. We now have had a series of months where we haven't had to prorate at all. But the idea is really to protect the performance of the vast majority of investors, 90+% of investors who want to stay in. And that's what institutional investors have lived with essentially forever. And that's what at least we set out to do, was to bring an institutional quality product to individual investors. Now, if you are a customer who wants daily liquidity, you're right, this is not for you. But if you want the benefits of thoughtful portfolio construction and that institutional quality management, these are interesting products for you. But I think you're right. Maybe, I don't know, I don't think our investors misunderstood, but I think some people in the market maybe.
But that's a structural issue where that is inherently a long-term asset matched with if you're looking at it as a short-term duration vehicle, or you're saying,
it's not what it is. Yeah.
It's not what it is. It's like the S&L crisis in the 80s. It's a complete mismatch, because real estate it's not immediately liquid. It doesn't work that way. So providing some element of liquidity can work, but when
there's going to be evolution of product too. I think without question. I mean, we also have a non-traded REIT we're proud of, but I think beyond that, there's going to be other evolution in product wrappers, and I think there's no question this demand pool is here. No question investors want access. Getting access to public markets. I mean, that world is not getting massively bigger, and so where are you going to go to find good returns? And so it's just it is the natural evolution of this space, but it's going to take some time too. So.
Barry?
Just on the non-traded REITs for a second, the press doesn't really understand two things. One, there is a difference. We actually have to, by GAAP, mark the gains and losses we have in the debt monthly. And it creates volatility in our marks. So when the curve goes up and down, we have $100 million, $200 million gains and losses, and it looks more volatile than it actually is. We're just doing GAAP accounting.
Yeah.
It's actually, and publics don't do that. The other thing that we do is we're pulled to par. We're at par. Whatever you think our mark is, that's the mark. Public stocks trade to wretched excess and wretched discounts. And it's a different vehicle. It's different than being in the public markets. So there's a place in people's capital structure. It's not a daily liquidity thing. And as Kathleen says, we have to protect most of our investors. We have to provide adequate liquidity, but we also have to protect the loyal investors we have that we're looking at this as not as a day trading thing. So, and don't forget, our dividends are very tax advantaged. So they're not comparable necessarily to credit, which is all taxable as ordinary income.
Ladies and gentlemen, thank you for your attention. Thank you for your questions. Please join me in thanking our panelists.